Continue our focus on consumer spending, which does, of course, make up 70% of U.S. GDP. And for more on consumer prices and spending, we're joined by Burt Flickinger, Managing Director at Strategic Resource Group. Burt, nice to see you again. Happy New Year.
Happy New Year, Michelle.
So, Burt, we saw consumer prices rose the most since June of last year. Is this significant? What's driving up these prices?
It's very significant, Michelle, because one, cost of medical services up 2.5%, electricity up 3.2%, double the national average, rent up 2.9%, energy up 3.2%. So we're really hits consumers in the pocketbook. Meat, poultry, fish, eggs up almost 3%. People are paying a lot more, and that's going to reflect through to 2014. So you had higher taxes in 2013, higher healthcare costs in 2014, plus a lot of key components of the consumer price increase going up almost at double the rate of the overall rate.
Well, how does that overall consumer price number work in with the Fed rate? For 2013, prices were up 1.5%. That is still below the Fed target of 2%. So how do you correlate those two objectives?
Michelle, you're completely correct. This is the first time in 15 years that the consumer price increase has been below 2% for 2 consecutive years. So the Fed's very happy. The Fed will keep interest rates low to try to stimulate the economy. At the same time, for consumers who have lower levels of income or fixed or limited income, seniors or people with part-time jobs, it's going to be tough.
Well, how do we reconcile all of these various data points? We've got prices up, then on the other hand, you've got, according to the Gallup poll, Americans reported spending $96 per day in December. That's the highest monthly average since September 2008. Then we've got the Bloomberg Consumer Comfort Index, which released today, which shows that Americans in January became the least pessimistic about the U.S. economic outlook. So it feels like we've got a lot of diverging data points.
It's like Charles Dickens wrote, Tale of Two Cities, Tale of Two Economies. You have the wealth effect of rising housing prices, wealth effect of a rising stock market. So middle to upper income consumers are feeling very good. Consumers at the lower levels of income are feeling not so good. Hence, Walmart, Target, Kmart really having tough Decembers, where the luxury retailers, Nordstrom's, Neiman Marcus, and Tiffany and some of the others doing much better.
Best Buy, bad earnings today, down 28% from the previous quarter or from the same quarter that time last year. So certainly some mixed pictures over here. Now, you mentioned that the housing market has made consumers feel more comfortable. How will the Fed tapering then play into effect? Because we are assuming that the housing market will start to maybe cool down, or the rate of growth will decline. What impact is that going to have on the consumer?
You're right, Michelle, that the Fed tapering will be a very challenging business balancing act between keeping mortgage rates affordable for consumers to continue to stimulate the housing market. At the same time, high-tax states like New York and California are seeing residents flee to the Sun Belt states that have lower taxes. So states from Arizona to Florida will have housing market growth. The growth in the colder states with higher taxes from New York through Michigan, Illinois, will see lower growth rates.
Burt, at the end of the day, isn't it all about jobs and wages? I mean, does it not all come down to wages increasing or not, as the case may be, and the employment picture getting better, which it still really hasn't?
It is wages and jobs. So if you look at the energy exploration areas, particularly Texas, Oklahoma, and through the Bakken Shale, wages of $100,000 or more per year, those states are doing very well. Unemployment of about 3 to 4%, about half or less of what the U.S. national average is, where in states with high employment, it's tougher.
Let's talk a little bit about some of the trends we've seen. And one of the more concerning issues has been those data breaches that we had from Target and from Neiman Marcus. What impact is that going to have? We saw the government sort of deciding to take an intervention in there. What impact is that going to have?
It's going to have a significant impact short term on shopping. Consumers will spend with more cash, less credit, which means consumers will buy less. And from my work in co-chairing the first debit card and instant bank and retail credit card system 35 years ago, it's the same cassette tape strips on credit cards that there were in the 1980s. So we don't have the EMV smart chips in the States the way people in Asia and Europe have to prevent cybersecurity. The banks who issue the credit cards get $30 billion in transactional fees. They should invest in cybersecurity, but it's going to take till 2015.
You know what you do when you use your credit card, a debit card overseas, you also include your PIN number.
Right.
Why does the U.S. not do that?
The U.S. should do that, and the U.S. should have smart chip technology. There's been a lot of criticism of the U.S. government, but the U.S. Secret Service and the Department of Justice that's in charge of cyber crime and credit card frauds doing an outstanding job. I was on the board of a company that was breached, appointed by the Creditors Committee, and the Secret Service came in within 24 hours, stopped the breach. There was no loss of customers. It's the Targets of the world, the Neiman Marcuses of the world that don't communicate to consumers quickly, and that's where shoppers lose confidence in stores as well as credit cards.
All right, well, we'll see how 2014 shapes up for the consumer. We're going to have to leave it there. Thank you so much.
Thank you, Michelle.